Hey traders, TG Watkins here, and in today's video I'm going to teach you how I trade 0DT spreads, specifically how I sell spreads, and we call them credit spreads. So a lot of times you'll see if it's a call credit spread, like we're selling something above, it's going to be a CCS, call credit spread, or if we're selling puts, it's going to be a PCS, a put credit spread. And you can tell the difference between that and buying it is because it's a credit and we want to sell it, so we're selling it for a credit, versus buying it, which would be a debit. Okay, so let's dive into this. I'll show you guys some of this. And these are the primary 0DT trades that I take in the Moxie room. So if you guys are interested, you can come into the Moxie Indicator Mastery, which is the trading room. We do run trials, and you can come in and check it out and see if you guys are a good fit for this. Otherwise, let's get into it. Simplertrading.com/trading rooms/Moxie Indicator. And yeah, we're going to be talking about selling credit spreads, why they work. So this presentation is going to tell you why this strategy works so often, and then setting up the spread, how to do that, and then when to use it. So let's dive in and show you guys all about this. All right, so why selling the credit spreads wins, and why does it win so often? Well, as you guys probably know about 0DT, they expire every day. So what that means is the majority of these options are going to expire worthless. They're going to expire out of the money. And that's what we want to be on. We want to be on the side of the majority in this case. And so oftentimes it can be easier to figure out where price won't go. So a lot of this, we can talk about any kind of stock, and this is the same thing that's true for monthly options, quarterly options, leaps, doesn't matter. All these options, everything I'm talking about is the same. We're just applying it to 0DT, meaning that basically it's today. And the reason we do that is because we know they're going to expire today, and the amount of theta burn, basically how quickly these things go to zero, is very rapid, and that's why we're very interested in trying to sell them, because they go to zero by the end of the day for the most part, and so we want to be on that side. And so we will benefit from time decay instead of needing to be right about a big move. So if you're going to be buying options, you need the price of the underlying, let's call it the SPX, you need it to move up or down very quickly or very strongly in order to overcome theta decay, or in order to overcome the just decay of the options. Whereas if you are selling them, you actually want that decay. And you can see here, this is an example that we actually traded just the other day inside of the Moxie room. In the morning, the market jumped up. Great, you know, if you wanted to be aggressive, you could buy these calls and you could do that. However, I felt that the market had gone up too far, wasn't going to last, and was going to likely then come down and just kind of fizzle for the day. So what I did is I waited for these options to come up and get to a turning point. And this is another thing that I'll be talking to you as we go on. And what I wanted to see is basically, here is the price of the option. This was a call in this case, and I wanted it to fade. I just wanted price to not go there. I wanted the SPX, so it's easier to figure out where price won't go. I thought that the market had gone too far, and I didn't think it was going to go much higher, and all I cared is that it just didn't go there. As long as price went sideways to down, selling this call spread would have worked, and that's what we did. We actually put it on right there, and we took it off right there. Turns out I could have made 100% from this thing, because ultimately it did go to zero. But it was kind of a tricky day. It was a little bouncy, and I just wanted to capture what we end up getting, about 40% in, I don't know, an hour or two, something like that. So pretty quick, and that's how fast these things will decay if you get them right. And that's what we wanted. We just wanted a slow, steady decline in this case in order for us to profit from these. All right, now the other thing, let's kind of talk a little bit about how these things actually work and how to set up your trade. Always make sure that you are familiar with your platform before you actually start taking trades and using real money. I can't tell you, I've done it in the past. I've pushed the wrong button and it cost me some money and it wasn't fun. I know other people have done that. They got it backwards or something like that. Sometimes there's a little bit of a mental situation here where you need to remember, oh, am I buying or am I selling? Which one am I doing? Just make sure you get it right and that you have good practice about this. So in this case, we're going to be selling, and this is just a random example, okay? We're going to be selling a call credit spread, and I happen to just pick this, and we're going to be selling the 6,000 strike, and because it's a spread, because you don't want to sell a naked option, meaning that is unlimited risk, you need to lock in your risk. And so by selling one and buying another, the difference between those two options is now your risk. I typically do about a 20 wide. You can do anything else. It just depends on your risk to reward and what you're looking at. So in this case, we're selling a 6,000 strike call, and we're buying a 6,020 strike call in order to limit our risk. And that is, we're selling it for $2.55. That's basically the difference. So you see here, here's the 6,000 strike, and you can say, well, let's just say it's going for $3.80, and this one's going for 50 cents. And so the difference between that is going to be the $2.55. And if this goes in your favor, you want the $2.55 to keep going down in value, because what you sold, you want to be able to sell all of it. You don't want to have to buy it back, for that much. And so that's the whole idea. You want it to go down, you want it to go as close to zero as safely possible, and then you can buy it back and you make the difference. And what you can see is down below, that's what it looks like for Thinkorswim. So you're selling one, you're buying one, and these are the strikes, these are the expirations, this is the product that you're doing. You can see that here you're selling and you're buying. And then you can see here, roughly that was the difference. So this thing was moving at the time when I was making this happen. So that's what that looks like. And then you can see here, this is how you read it. So you're selling one vertical, and it's on the SPX. It's a June 18th, 2025, 6,020 call for that amount of money, and LMT means that it's a limit order. You can do market if you want, but there might be some slippage, so a limit order is usually preferred, okay? And that's how you kind of see this on the screen. All right, so then let's kind of take a look at this. So what the spread actually looks like. Now, this is pretty interesting. Even I had to learn that this was possible. You can plot you better look right there. You can actually plot the spread. So in this case, I took a screenshot a few days ago, that one that we actually took. We sold, let me change this. So we sold the call credit spread right here for about $8. And we let it go down, down, down. And I think we sold it for right around here about $5, which was about 40%. And so you can see, we want this to go closer and closer to zero as we make money. And so finding the right place to get this is good. Either you can find a turn or a pivot or a break of a moving average. And if you guys remember from some of my previous videos, I like to visualize the options. If you guys don't know what I'm talking about, go back, look at my original How to Trade Zero DTE video, and it will talk about and show you guys how you can actually visually plot the options just like a chart. Instead of having to use the options trade grid, you can actually look at it like this. And I think it adds a whole new layer on how to trade options. It gives you now this visual picture. And I think that is great because we know how to trade stock using charts, not tables. And so this is where you can trade options using charts and not tables. And so what I did is I was looking for price to get rejected by this 2-minute 50 in this case. And so you can see that I sold the credit spread right here as price got rejected and started to break down below the previous low. And basically it just kind of went down and down and down. I decided there was a location that I liked, it was about $5, 40%, cashed in. Yes, you can see there happened to be a bounce, but look what happened after that bounce. This continued to just drift lower and ultimately went to zero, which means I could have cashed in all of my $8 and pocketed all $8. Instead, I cashed in the difference between the $8 and the $5, which is free. So I made $3 on this trade. And remember, when you're selling, you want the price to go down. Now, if you're buying, like if you're going to do spreads, and I'll make another video on debit spreads, but if you're going to be buying a spread, like a debit spread, you want the price to go up. So just making sure you understand these differences. Once again, to show you how to read these things, I have it over here, how to read the option. So first, you have the product or the ticker, and in this case, it's the SPX, right? And then you have the date. So which one are you picking? This is 2025. This is June 18th. So now you know what series of option that you're trading. And then you'll have a C or a P, that's for call or put, and then you'll actually have the strike. And that's a 6,000 strike right there. And what you can do with Thinkorswim, and you can probably do this on other platforms, but you take the sold strike minus, and you can see there's actually a minus sign. You can see that here too. You say minus, and then you do your bought strike, and it will automatically populate your spread for what value it is. So you can see here, $8. That was our value. So it's pretty neat, really interesting to see this, and really it's such a fun visual because now you can actually trade this like a regular stock chart. Okay, now the risk. This is something that's important. Again, if you're kind of new to this, make sure you understand, kind of study this a little bit. If you're selling an in-the-money spread, the risk to reward is better, but you need to be directionally correct in order for price to go there, in order for price to, for you to make money. So if you are, let's say, price is here and you are selling a call credit spread down here, if price stays up here, you're not going to make money. You need price to actually come down and then hopefully go further, or at least come down and reduce how much it's worth because you're trying to sell it for money. Okay, so you need to be directionally correct. Now, as I said, the risk to reward is better. If you look here, your max profit on this example, let's just call it was $4,000. Your max loss is $80. Now you look at that, you're like, wow, I would love to get $4,000 by only risking 80. Okay, well the reason that this is pricing this way is because it's unlikely to work. Okay, that's kind of how they price these things. This example was so far in the money, it was unlikely that price is going to go down there. It just isn't going to. So that's why it says you can make more based on less, because it's probably not going to work. Okay, so that is something that you need to look at, and you can see here this is what it looked like. I just did something that was deep in the money. Now, selling an out of the money spread has a less favorable risk to reward. So for example, you can see your max profit would be 200 max profit, but your max loss would be 1,800. But the trade-off is that it's more likely to profit because it's unlikely that price is going to go there. So again, if the market is here, you are now selling a call credit spread up here, and this is saying that it is unlikely that the market's going to go up there. It is more likely that it's going to stay sideways to down, and so you have a higher likelihood, a higher chance that this thing is going to work for you, meaning it's going to go to zero, and you're going to be able to cash in all 200. Okay, so that is how you kind of look at this. Now, if you're really looking at this, you're like, wow, it doesn't make any sense that I'm going to risk $1,800 in order to make $200, and you're absolutely correct. That would be a very, very dumb situation to do. So what you need is you absolutely need to have either your exit strategy or a stop loss rule. Okay, so rule of thumb, what this is it's going to be twice the max profit. So if you could make $200 on this trade max, that is how much you're risking. So if it goes against you $200, you need to get out. Okay, or the same way to say this is it's twice the price you sold it for. So for this one, you are selling it for $2. If this thing goes up to $4, then you need to sell it because now it's going against you. Okay. Of course, maybe this looks very narrow, maybe a little blip, and it's already against you. This is where you need to kind of start figuring out how to strategize how to set these up. If you go further out of the money, you're not going to be making as much, but you're going to have a higher likelihood this works. If you're going closer, you will make more money, but now you risk the market actually going against you. So it is a delicate balance, and I do still like to trade these even directionally. If I think the market is going to go a certain way, I will go a little bit further in the money in order to make more money. Since I figure the market's going to go that direction, I might as well have a better risk to reward. Okay, but absolutely important that you understand the stop loss situation, because you do not want to be taking a full max loss when you're only potentially making 200. That just doesn't make sense. Okay, so here are two examples of when to use credit spreads versus kind of going long the market or along a directional option. So remember, buying a 0 DT option requires price to move to a location that you want with energy in order to come theta decay. Okay, so you need a big move. Selling 0 DT options simply needs price to go anywhere but there. I just don't want price to go there, and then you can make money. So it's kind of a nice way to look at it. And these selling credit spreads works well on trending days because if it's trending, you just keep selling below, so that works. I like pivots. I like it when it turns, because if I can figure out where it turns, then I can get more right there. Basically, I can get a lot of money here, and as it turns, then it moves away from that, and then I make money. At resistance or support, kind of the same thing as pivots. If I can tell that there's support, well, then I want to sell when it gets to those. Or if there's resistance, I want to sell at resistance. Calm days, because obviously if it's calm day, buying premium is not going to work because the market's not really going anywhere. Or range bound days, if the market keeps kind of going like this, then you can sell above and you can sell below, and maybe that's like an iron condor that you can do for that. So let me show you these exact examples. These are both 5-minute charts on the SPX. Now, if you bought an in the money call down here, yes, this would have worked and you would have made some money. Now, if you bought it out of the money, depending on how far out, it might not have worked. This would be challenging because honestly, it was probably a surprise that the market moved up like this. So if I didn't think the market was going to jump up like that, then I don't think that there would be that much room for price to come up here, and so I don't think that the calls would have appreciated much, and therefore I really didn't want to risk buying directional. But the fact that I could see that, hey, price is probably just going to grind a little bit higher, selling premium below, like put credit spreads, would be a great trade, because as long as price doesn't come down, you're going to be making money on those things. And so I would have viewed this as a great thing to sell credit spreads for, put credit spreads. Now, here was the one that we actually took. This is the example that I was using earlier. You can see how the market ran up right there. Great. It was based on news. It was a fast move, not really my style. I was waiting for an opportunity. And the opportunity came when I was able to determine that this thing was way too high and it was likely to come back down and find support. So that meant that I just needed to sell calls or call spreads above price as it went. I looked at this one too, trying to buy a put, really wouldn't work. This thing came down so gently that the puts did not really appreciate in price enough to overcome theta. So this was another case where you can be directionally correct, but you won't make money because it didn't go fast enough to offset the decay. Okay, so what we actually did is when price was here, we actually sold a slightly in the money call credit spread. And yes, I needed it to be directionally correct. I did need price to move down. And I could tell that was going to happen, so I gave myself a better risk-to-reward ratio, and I was able to make more money on this because I chose an in-the-money credit spread, and I was directionally correct. There are times where, if you think something like this has happened, you can sell above. You won't make as much money, but you will be more likely to be correct and higher likelihood of just cashing in that trade. Okay, so there are some examples there. Now, if you guys find this interesting, of course, I'm going to be having numerous webinars coming up about these things. I do trade these live in the room quite often. And if you guys are interested, you come into, I actually have classes for these, so you can come into the Moxie trading room to watch this stuff live. Or if you actually want to buy the class, if you find this interesting, I have a whole class that teaches my whole method about how to do this, how to use the Moxie Indicator, which is my proprietary indicator, which really helps if you figure out where the market is going and how and when. And then it shows you everything, just, A to Z about how I trade these things both directionally and selling credit. Okay, so you're going to be looking for the 0DT breakout session. Remember, just look at our website or in the link below or call our customer support. They'll help you with that. And we've had some really good responses. Anne was over here saying that my 0DT video is outstanding, so she had a great time with it. And then one of our newer traders here, Eric Hardwood, was responding to one of our other traders in the room. He said, yeah, plenty of examples in the 2+ hour course, which is the 0DT course. And it allowed him to place his first few 0DTs yesterday, made some profit, and paid for the course already. Okay, so we really do have some great feedback about this. And if you guys are interested, come on over, check out the room, check out the class. We're here to help, and we just want to make sure that you guys succeed and learn everything that I've been learning over the last couple years. Okay, thanks again, and we'll see you at the next one. Hey, TG here with Simpler Trading. Thanks for watching. If you enjoyed this video, be sure to leave a like or comment below. Also, make sure to subscribe and click that notification bell so you can stay up to date with my market analysis. Or you can join my free newsletter with the link in the description. Good trading, and I'll see you at the next video.